No problem. Sorry about this. Okay, so today's talk is titled Winners, Losers, and Regulators in a Nascent Derivatives Market. And the reason I'm doing this talk is because I thought that people at EGROW are obviously concerned about financial market policy and regulation, and this paper has something useful to say about that issue. Derivatives are obviously very much in fashion. They've been in the spotlight since the GFC. And obviously derivatives are fairly widely used in India, like single stock futures and option chains on Nifty and so on and so forth. What? Sorry, boss, what?
Please go ahead. Please go ahead. They've just started the recording.
Oh, no problem. Please do.
Yeah.
That's no problem. Okay. All right. So my paper is concerned with options markets. Okay. So options markets are obviously our markets that have become pretty popular in most countries. And obviously, India has its own options markets for individual stocks and commodities and so on and so forth. So options are interesting because they're not quite that easy to understand. So the question is, when you introduce this security to a market, whether people actually understand what they're trading. And we're going to argue that in fact, retail investors don't quite understand what they're trading when they're actually trading options. Even though finance professors might understand them, the traders themselves don't, is what we're trying to say. Then we have some implications for policy, okay? So basically, this is the content of the talk, but in 35 minutes, I won't present every slide. I'll present the more central slides, okay? So to introduce and motivate the topic, basically the issue is that we have a lot of studies where we talk about trading and profitability in equity markets and very few on derivatives. And the relevant question is who wins and who loses in these derivatives markets, and do people actually understand these types of securities? Now, obviously, China is not really in favor these days for various reasons, but at this particular point, I think this data set from China is kind of useful in understanding whether people actually understand options and who wins and who loses in these markets. So we're going to use basically some data from China. But the reason that's relevant is because it's unique data that has trading histories of people in options markets, which other data sets across other countries do not provide. Another motivation is that, many people talk about, people wanting to take more or less risk. So people often say that overconfident people take more risk in the economy. But our question here is a little more basic, which is that do people actually understand the profit function? Forget the variance, which is the risk. Do people actually understand the profit function in options markets? And so that's essentially a more basic question that we're trying to answer in this market. All right, so before we proceed, I think that if you don't really review what an option is, we'll get into trouble. Now, obviously, options, you can just Google Nifty options and you'll get a screen describing something called option chains and so on and so forth. For those of us who might not exactly be familiar with options markets, let me just review what these things are. Because if we don't understand that, then we're going to have issues later on in the talk. So, okay, so just to review, for many of us, and so introduce these things. It's really not that difficult to understand it once you get the hang of it. So there are two kinds of options, call options and put options, and they're also called warrants in certain contexts. But for our purposes, the distinction between option and warrant is not relevant. So we're going to ignore that distinction and assume that options and warrants are the same. So a call option or warrant is the right to buy shares at a fixed price. For example, you could have the right to buy United at a 50. Okay, this is called the strike price. Okay, so important. That 50 is the strike price. So just to use some technology, that fixed price is called the exercise price or the strike price. They're the same thing. Okay, so if suppose United is trading at 60 in the open market on NSE, it's trading at 60. If you have the right to buy United at a fixed price of 50, which is exercise price, then the immediate profit obviously is 10, not 50, but 10. Okay, so it's 10. Okay, and we say that the option is in the money. Okay? So you essentially pay 50, get something worth 60, so the immediate profit is 10. Okay. The call price should be at least 10, right? So nobody's going to give you this right for free because you're fixing the price at which you can buy the underlying stock, and that underlying stock could be any number, right? So nobody gives this to away free. So these things are actually traded on the exchanges, and the call price is then the price of this right, which is going to be in this case at least $10, right? So if your immediate profit from doing the option deal is 10, then the price of the thing cannot be less than 10. It probably will be more than 10 because you have the right to change your mind later. Right? So these options have a fixed expiration date. So before the expiration date, the call price is going to be at least the immediate profit, and the rest of it is just the time value between now and the expiration date of the option. So it's important to know these concepts, exercise price and price. Exercise price is the right at which you can buy the shares at that fixed price, which is fixed when you buy the option. Okay, so that price does not change. The bigger the value of the underlying stock, the more the immediate profit, as you can see from this example. Okay, so the right, so the call price should be at least $10. The put, on the other hand, is the right to sell shares at a fixed price. Okay, so I'm not going to go through that example, but it's the reverse. As I said, these things have a fixed time to maturity. And more importantly, remember that they can expire worthless. For example, in this example, if United was at 20, right, and you had the right to buy it at 50, the option's worthless, right, at this moment in time. And suppose that you're approaching the maturity date of the option and the stock is well below the exercise price. Then obviously the option's worthless, right? So what's the point of buying something at 60 when it's at 10 or 20, right? So when they expire worthless, then essentially you lose everything you invested in the option, right? It's basically, you get nothing. So your loss is basically 100%, negative 100%. Okay, what's the advantage of these things? They both give leverage, right? So the magnified profits and losses per unit investment, because if you want to buy United, you buy it at 60, right? But you buy it through the option, you can buy it very cheaply at 10. So your profits and losses are magnified because you invested very little for the upside, but you have a lot of downside because obviously you could lose everything. If you invest in the stock, it's unlikely you lose everything. The stock's not going to go to zero, right? But the option is very likely going to, it's a good chance that it'll expire worthless, right? Another interesting thing about the options is that out of the many options, OTM options have high skewness, right? The reason they have high skewness is because they're lottery ticket. Because say that United in this example was at 20, then the options at this moment worthless. So its price should be very low, right? But with a small chance, the stock will end up above 60, above 50, and you make a big profit. So that's like a lottery ticket. Very, very little investment with some small chance you can make a big killing in the options market. So it's also true that it has high skewness, especially if it's out of the money and extremely cheap. By that means that you pay very little money with some chance you make a lot of money, and that's like a lottery ticket, which has high skewness. So these are the features of these options markets. Now, obviously, other than betting, they're also used for good things like hedging, but we don't have time to review those things. I'm just giving you the intro just to make sure that we are all on the same page. So please understand that there's a call price, there's an exercise price, and then the underlying stock price. And I just explained to you how they relate to each other. Another thing, please note that in options, there's extremely great chance that you lose everything. Because as soon as the stock goes above the exercise price, the option's immediately worthless for the moment. And at expiration, if the stock is below the exercise price, the option expires worthless. So you lose everything. Okay, those are important. Okay, so moving on. This particular market that I'm going to talk about, as I said, warrants and options are the same thing for this talk. They're introduced basically for the first time in that country. And so the question is, in that first stage, do investors actually understand the contract's complexity is the question. So we're going to have detailed brokerage data that allows us to understand why people make or lose money in these markets. We're going to also talk about regulators imposing price limits in these markets. And we're going to argue that the price limits actually themselves create some confusion in the market. And regulators put price limits in both underlying stock markets as well as derivative option markets. And we're going to argue that not only are investors confused, but the regulators are also confused. So we're going to show you exactly how and what we can learn from this episode. Okay. So we're going to show you that a lot of people lose money in these markets. And the most people who lose money mostly are people who buy options that are essentially out of the money, that are going to expire worthless. And they seem to be trading these types of things as a lottery ticket, but they're treating them as a lottery ticket in terms of the stock. And there's a difference between buying a low-priced stock and a low-priced option. because with stock, it's unlikely to go to zero. Companies don't normally go bankrupt. They could, but very little chance it'll go bankrupt. But with options, the lottery ticket is highly likely to expire worthless because the stock has to go all the way to zero to expire worthless, right? But the option just has to go to a point where the stock is below the exercise price to be expire worthless. The exercise price is a positive number, and the stock can go below the exercise price quite readily, right? So the lottery ticket and option market is worse than stock. The stock cannot go to zero, but option value can easily go to zero. As soon as the stock goes below the exercise price, it goes to zero. So we're going to show you that investors are buying options where the chances of making money are actually nil, zero, and still they're paying prices for these options. Okay? And the policymakers don't understand these contracts either very well. So we're going to learn from that. So we're going to basically just first give you some summary statistics that this one just says that it was a very popular market, this market that we're going to look at. Okay? So in fact, the total turnover value, the trading value in the market was 29% of GDP in a particular year. It was very, very popular. And it's a fairly major market, was a major market. And why did this market actually come into place? Because essentially what they were trying to do was to create the following situation in the Chinese stock market. A lot of state-owned enterprises, SOEs, were being given back to the public. So by giving back to the public, the state-owned enterprises were increasing the supply of shares outstanding, the float. They were increasing the float. Now that diluted the holdings of investors who were holding these shares, right? Because when the state sells the shares, it dilutes the holdings of the existing shareholders. So to compensate for that, they just gave them options. Like, here's some options which compensate you for the increase in the float, which dilutes your holdings. Right? So you have all these investors that suddenly got these options markets where they didn't really understand. They were not very familiar with them. There were no other established options markets. And so the question is, did they actually understand what an option is? Right? So they just given these options all of a sudden, and then they could trade them. And so the question is that did they actually understand what this option actually? First, give you some statistics on these options. Okay? So you can see from this particular picture, there are the y-axis is the trading volume in the option, that most of the option volume is in the out of the money options, which means that they are in options which the immediate profit is actually zero. Right? And so that sort of helps you understand that maybe they're just treating it as like a lottery ticket. Like they want to buy these low-priced options. Out of the money options will be low-priced, right? Because the immediate profit of exercising the option is actually nil. And then you're kind of hopeful that in the future it will basically come in back into in the money and you can make some money from the option. And so that's the hope, because you can see that most of the volume is concentrated to the left when the option is out of the money. Out of the money means stock price less than exercise price, okay, for the call option. Okay, and so the other thing to understand is that the skewness of the option is essentially high when the option is out of the money, like I already told you, and this graph just confirms that. And so the volume is in the high skewness options, right? You can see that. So that's one observation. Like I said, I don't really want to spend too much time essentially talking about a lot of these details, but very quickly, we have trade-by-trade data on these options markets for a relatively long time period. It accounts for 3% of the volume in the entire market. And some people are institutions in this data set, but the bulk of them are just retail investors. So that's all this is saying, what the data are. Okay, so one other thing, one feature of these options that is essentially worth pointing out is that options can be either European or American. The difference between European and American is that European options are exercisable. That is to say, you can make profit on them only at the one date, which is the expiration date of the option. Whereas American, you can make the profit on any day. You can exercise the option on any day prior to the expiration date. Okay? We have call and put warrants, and all put warrants are European style. Call warrants are either European style or Bermudan style, but you don't need to worry too much about this for this talk. The Bermudan style simply means that you have a longer period for the exercise after expiration. So once it expires, you have up to maybe a week to actually figure out what you want to do with the option, right? So you have a 1 week period after the expiration date to decide whether to exercise or not. That essentially is the difference. So the option is not traded at some point in time, but it can be exercised up to a 1 week or later. And the later the time window you're given to exercise, the more different from a traditional option it gets. And Bermudan means you have a long time, basically. And there are daily price limits on both the options warrants as well as the underlying. So keep that in mind. Okay. Basically, first, some important summary statistics that there's a lot of volume in these markets. That's what the first bullet point is saying, right? So the turnover volume is about 1.5 trillion overall, or 220 billion US dollars in trading volume. However, in terms of the, since we have brokerage data, we can account for the actual profits or losses of investors. And in aggregate, people lose about 220 million by trading these options. So there's a net loss of retail investors of that amount. Okay, the institutional investors make a slight amount of money, but the overall loss for the in retail investors is 220 million USD in aggregate. And this particular number hasn't been documented for options because people haven't had the data. They've looked at stocks, but this would be one of probably the first study that actually shows that derivatives means that retails lose money. They don't really make money. Okay, and another thing is that 94.1% of the loss, which is that number, 1.38 billion, is due to OTM expiring warrants. That is to say they're holding out of the money expiring warrants and not understanding what these warrants are actually all about. Okay, so 94% of the loss of retail investors is just holding worthless options, which basically have no immediate profit, and in fact are literally expiring worthless. So you'll never make any money from them, but you're holding them, thinking you'll make money when the chance of making money is nil, zero, and that's why you're actually losing money. Options. So these are some important figures. Okay, just to give you a couple of issues in terms of what exactly is the cause of the loss. Okay, so what we're doing here is that we're regressing the net profits of investors, which essentially is a net loss, as I told you, that on aggregate they lose money on a large number of variables, but I'll focus your attention on just skewness. Skewness is simply what the option skewness is, right? And I already told you that investors lose money by trading these high skewness options. And so this one just says that the net profits of all investors are negatively related to skewness, right? So the bigger the skewness of the option, the more money you lose by trading the option, which essentially is something I've already gone over. So this just confirms that using regression analysis that traders just, trade these high skewness options and lose money. So that's that. Another thing to note is that just not worry about every coefficient, but what in terms of, apologize, so what happened? So going back to the slide, in terms of popularity of the options contract, right? This one says that volume is high for high skewness options, the T very high of 71, right? So skewness also determines the popularity. So these high skewness options are very popular, but like I showed you on the previous slide, the high skewness options is the one in which you lose money as well. So that's essentially the takeaway from this. At this point in time, what I'd like to do is worry about the relevant and more interesting part of the analysis, which is essentially this part, and then one other part. So recall that I told you that more than 94% of virtually all the investors' losses can be attributed to OTM matured warrants, right? So warrants that expired worthless, on which the profit is guaranteed to be minus 100%. You lose everything, right? Okay, so what we're going to do now is to take a look at trading behavior just before the maturity date of only OTM matured warrants. It's important that this particular part of the talk only focuses on those warrants or options that expired completely worthless, which means that that you will make no money from them, and you should have known that. Okay, just that, those options. Okay, just that. So focus on the notion that these analyses are just for worthless options. Okay, so sorry about that. Okay, so let me first show you what institutions are doing. So they essentially have a very high trading volume in these worthless options just before expiration. So you can see that their trading volume actually rises just before the option expires. Remember, this is only for worthless options. So that's one thing to note. That's what institutions do. In terms of trading volume by profitabilities, this is not conditioning on institutions, but these are the most successful investors, and these are the least successful investors. So you can see that trading volume actually declines for the most successful investors around expiration, but it actually increases for the worst performing investors, right? So remember, these are all worthless options. Only those are being considered here. Only those. So just to build more intuition. Now remember, the options expiring worthless. It's only being done for worthless options, okay? So your holding, if you understand an option, should be 0 in all these options, right? So institutions reduce their holdings, okay? And another thing to note, this is just holdings, how many options you're left holding at expiration. It should be 0 because the option is worthless, right? So you can see that the top most successful traders reduce it to 0, and the least successful traders actually end up holding these worthless options. Remember, there's no point to holding them if you understand an option because it's expiring worthless. So that's that. Not only that, in fact, these options are worthless on day 0, but there are some new investors actually ending up buying these worthless options before maturity, not knowing that they're worth 0. So the blue simply means there are new investors that enter the market on the last trading day. And that is obviously irrational, okay? In terms of the profit and where it comes from, this is just the day trading profit. So individuals that turn around positions within a day, whether they make money or lose money. And you can see that individuals actually lose money by doing day trading, and institutions make money. So that's that. And these are all worthless options, remember that. Completely worthless. So they should be doing nothing, but yet they end up doing something. Okay, so that essentially is all I wanted to tell you about that particular angle. So they lose a lot of money, and the bulk of their losses are because they end up holding worthless options, which is what I just showed you, and doing day trading in worthless options. So that's the logic. Now what I'm going to do is to give you a feel for what we can learn from this by doing a case study. By case study, I mean, I'm going to take a look at one specific option and what happened to it around expiration of the option so that you can understand what exactly were investors thinking and doing in more detail, and then we can see what we can learn from this experience. Okay. So this is a specific option. Okay, one specific option. All right. So this was a call option, which illustrates the points we are trying to make. Its exercise price was 19.26. The exercise ratio was 1.01, which is just the notion that for each option you get 1.01 shares of stock, but that's not relevant here. It's not going to play much of a role. We have another quantity thrown in, which is exercise ratio. Important to note that the exercise period for this option was between 19th August and 25th August, even though the option expired on 18th August. So after 18th August, you could not trade the option, but you could exercise the option if you wanted. That is to say, you could change the option for the share at a fixed price of 19.26. So remember that. The exercise price is 19.26. Then you can exercise the option for the underlying share at any time between 19 August and 25 August. Now, here's the thing. Assume this option is on Apple, right? You can get Apple at a fixed price of 19.26. That's what the option says, right? But Apple's closing price on the underlying day was 11.71, okay? $11.71, okay? Okay, now remember that this is a call option, okay? So it's worthless because you buy Apple at 19.26 through the option, but the Apple is only worth 11.71. So it's a useless transaction. You don't want to do that, right? So literally, this is a worthless option on August 18th. It's worthless. And I'll tell you more specifically why it's worthless in just a minute. Okay. So remember, though, that there's a slight complication created by the fact that you have 1 week to change your mind, right? So you can decide to exercise it within that 1 week period. Now, regulators have set price limits on the underlying of 10% up and down. So the stock's not allowed to go beyond the 10% bound. So each day it can either go up by 10% or down by 10%. And once it goes up by 10%, it cannot go up any further. Down by 10%, it cannot go down any further. Now you have 1 week to change your mind. and it's currently 1171. So the question is, in that 1 week period, can it go above 1926, right? That's when it might become profitable in the future. But it so turns out that the way regulators have set the rules, it cannot, because it's currently at 1171. And the maximum upside on it is just 11.71 plus times 1.1 to the 5. Because over the next 5 days, it can only go up at most by that amount, right? It goes up 10% every day, right? So if you apply that factor, it's still zero, because that number, 11.71 times 1.1 to the 5, is not above 19.26. So it's still zero, right? So it really, with this warrant, there is no chance that it'll ever make money. None. There is just no chance. So now we'll talk about what happened to this option in just a minute. But one other thing is that the regulators have also set price limits on the underlying option or warrant. And they said that the warrant cannot move outside those boundaries, which is the maximum of zero and the warrant price minus the stock price times 12.5%. Where they came up with, I don't know, but that's the rule. So the boundary on this is that it cannot go beyond those points. Okay, so that's the price limits of the warrants. We'll come back to those in just a bit. So just wait. Okay. So now let's talk about what happened to this warrant. So this warrant was actually very popular on the day before it expired, even though it was worthless. So the turnover was 1,700%. And actually, the trading was so popular that it went outside the boundary and it was halted at 1054 because it went outside the price limit. So literally a completely worthless option with a turnover ratio of 1,700%. It was turned over 1,700%, 17 times on that day when it was absolutely worthless, basically. Okay. Just to give you a feel for the retail traders and their naivety, if you look at what was happening to this option on its last day when it was worthless, it's worth zero, they were actually posting bulletin board posts saying like, why is it stopping trading? Will this warrant disappear forever? Why is the trading in the warrant suspended? And so on, thinking that it was going to make them a fortune in some cases, right? So they didn't quite understand it was literally worthless. Okay. Then they seem to be confused between the option price and the exercise price. So the option price was some number above zero, and the exercise price was actually fixed. But they didn't seem to understand that the exercise price wasn't a measure of the profit. That wasn't the price that denoted anything to do the profit. In fact, the option was worth zero. They thought they could buy the option at 1.62, which is the price of the option, and exercise and sell it at 19 and make money, which you could not do. The option was actually worthless. So they were all saying like, we're going to make a ton of money on an option that was literally worthless. This particular situation that I described happened in many cases. These are all the cases that happened. We can't review the case, but these are all cases where people were trading options that were literally worthless with some positive price. Okay, so just to give you one more aspect on this, I wanted to take a look at this specific warrant. 1 day before the last day, the day before the last day, where something else happened to this warrant that's somewhat interesting. And what happened on this day was the following, that like I told you, that if United is at 60 and the option gives you the right to buy United at 50, the value of the option is basically 10, right? At least 10, if not more, right? At least 10, right? So let's say that you're 1 day before expiration, which is the penultimate day, right? The 1 day before expiration. Then since there's only one more day to change your mind, the value of the option has to be, approximately equal to the difference between the underlying and the exercise price of the option, right? So that number for this option was actually 1.2. That this option had a maximum profit of 1.2. That's the max you could make from it on the penultimate day, okay? But the regulator set a limit such that the option couldn't go below 2.2, right? So essentially the regulators were preventing the price from reaching the correct level, right? So then the notion is the regulators themselves set price limits that didn't anticipate what prices the option market could reach, okay? So here we have a situation where not only are investors confused about what they are trading, right? they're trading literally worthless options. There are no chance they can make any money from them. And to make matters worse, regulators are setting limits on the options market such that the value of the option cannot reach its upper maximum profit, which means that traders are getting shortchanged by the regulators themselves. Regulators are supposed to maintain fair and orderly markets, but the limits are not set correctly. So let me tell you what exactly is happening in terms of, in that particular slide, what happened. See, the daily price limit of the warrant or an option has to be within that boundary that I just told you, right? So these boundaries essentially depend on the value of the option tomorrow. For example, if you look at the right limit, right, the value of the option to the price of the option tomorrow cannot exceed the price of the option today plus the stock price, the underlying stock price, times 12.5%. Right? It just simply cannot. Right? But if this number is very, very high, so in other words, the option is actually overpriced, right? If this number is very, very high, then the next day's option price can be outside the upper bound of the maximum possible profit, because the original number you started with on a given day is so high, the option is so overvalued that the next day's option price cannot actually hit its maximum profit. It has to be above the profit because the number you started out with from the previous day was too high. Right? So if you simply apply this formula mechanically, you could end up with this number, WT plus 1, the boundary on the number that is above the max profit, which means that the option can't really hit on this number too. So you can both these numbers could hit. Both these numbers could hit numbers such that the option cannot be below its maximum value. Right? So it could turn out to be that the maximum profit on the option is 1, right? But the price cannot be below 2 because the previous day's price was so high. Right? So the previous day's price was too high. If you apply this formula, then this day's price will always be above the maximum profit, which means that traders can't trade the option at a fair price. That's what's going on here. So in this case, regulators didn't quite anticipate how the option might behave. And they set limits such that the option price on a given day would necessarily be above the maximum profit, causing traders to overpay. That's essentially the point. So in this particular situation also occurred on several instances. And these are all the instances in which it occurred. Right? In 20 cases, the auction price wasn't allowed to come below the maximum profit, which means regulators didn't allow traders to trade the option at fair prices. Okay, and so I told you I would just take 35 minutes. I'm going to end it and open it up through chatter. So the conclusion I would like to have is the following. Any new security that you introduce runs the risk of not being understood by people. Right? And so it's very well to get finance professors from abroad to talk about option markets. They're great and they're for theoretical reasons. But the fundamental issue is whether traders who don't understand, who are not familiar with derivative securities can actually understand what these securities are all about. And what I'm trying to argue in this particular case is that they didn't understand it because basically they end up holding these worthless warrants, and many people pay positive prices for options or warrants for which there's a zero profit, guaranteed zero profit. It's completely worthless. It's a worthless contract, but still people pay huge amounts of commissions, trade them very actively, and pay positive prices for them. And regulators seem confused. They don't seem to understand the market very well because they set price limits such that the price limit bands don't allow the option to converge to its fundamental value, which means that traders overpay for these options. And so the moral of the story is that when you introduce these new markets, even if they're ongoing markets, you need to monitor the source of the profit and loss and understand who's losing money, who's making money, and whether the people who are trading these options actually understand what they're doing. Because after all, policymakers' goal is to not only just introduce new markets, but also to make sure that people who trade them actually understand them. And if they don't understand them, then we need to revisit this issue. It's not enough to argue that people can fill out questionnaires and then we know they understand them, for the simple reason that filling out questionnaires doesn't mean they can actually put that into practice. So one has to monitor these markets very carefully. And when you introduce new markets, you have to make sure people understand what they're trading. And that is all, Charan, I have to say. And so what I'm going to do now is stop sharing the screen and come back online so we can open it up for questions.
Thank you very much, Professor. This was really interesting and very important for us. In our country, we had introduced the derivatives, and I'm happy to tell you that the guru of derivatives in our country is chairing the session today, Mr. V.K. Sharma.
Mm.
He was the executive director at the RBI, still on the boards of many institutions, and he is chairing the session. Let me hand over the mic to him, and he will conduct the session further on.
Okay.
Thank you, Charan. Can you hear me?
Yes, I can, sir. Yes, I can.
Yeah.
Yes.
So, Professor Avanidhar Subramaniam, thank you for a very good presentation on the warrants. But only thing I want, I'll make some comments.
Sure.
If it's okay, that in fact from the the title of your presentation today, it looked like talking about derivatives generically. I was not very sure about we're going to talk about warrants. That is one thing. But I had some, you being an academic and very renowned academic, I would like to raise a more, what according to me, what is more relevant issue is from the regulator's point of view is this physical settlement versus cash settlement. What I have found is that in India, as we have, evolved the derivatives market, somehow it has always been cash settled. In fact, in one of the Flame Universities, I delivered a keynote address. The title was Regulatory Issues in Derivatives, Doing the Right and Not the Easy Thing. What I find is in developing market, nascent markets, regulators are allowing right, left, and center the cash settled derivatives. I'm a firm conviction that a derivative where physical settlement is possible and it is cash settled, it is a non-derivative, because it breaches and violates the law of one price, the law of this cash risk-free, riskless cash derivatives arbitrage. So what is your specific take on this?
Okay, so see that. So the thing with this is that there is a reason that people actually do cash settlement, which is convenience. No, so like if you involve a physical, let's take wheat. Okay, wheat, you do a VADA or forward contract on wheat. If you require cash settlement, if you don't require cash settlement, you require the physical to be delivered, then people have to store the wheat, no? So they have to make sure that if they buy they sell the wheat contract, they have to make sure they actually have the wheat to deliver. The problem with this is the logistics of that, right? So in other words, the contract may not be very liquid because it won't attract traders who are not in a position to actually deliver the underlying, right? So like, it depends on what the regulator thinks the role of the derivative is. So if you think the role of the derivative is actually to make the market more efficient, like, what's the price of wheat going to be in, like, say, 1 month? If you allow non-cash settled contract, you allow more people to trade the contract, then you get the wisdom of the crowd and the price in somewhat more reflective of the future value of wheat because you have more traders. If you require physical delivery, then every trader thinks that, oh, there's some chance I might have to make the delivery, and so I'm not going to trade the market because I don't have the resources to go hunting around for the deliverable. I just want to speculate, right? So like also consider like oil contracts or petroleum contracts, right? Price of oil. People don't want the hassle of going around trying to make delivery of bushels of oil, right? So they say, okay, fine, if cash settled, I'm doing it. If not cash settled, I just won't trade it. So you'll have less liquidity, less trading, less interest in the market. The flip side of that, of course, is that if you delink the underlying from the cash, underlying from the future derivative completely, then you have basically a gambling market, right? Like people are just gambling market. So, the problem with this is that you can't really give a policy prescription because it depends on whether you like liquidity or the notion that the market is just a side bet or a casino gamble on the underlying. It's like a trade-off, no? But I would argue that in countries where the institutional infrastructure is not quite such that you can trust everyone to do the right thing, it's quite complicated in a big country with high population density, that introducing the deliverable might make the markets so less liquid that you may want to consider cash settlement. That like it's a more question of let me also just say convenience also, right? Like cash settlement just makes
No,
it
I've got a sense, sorry to interrupt, I've got a sense of what you're saying,
yes,
but
yes.
I interject here and say, the thing is that nothing prevents the people, even in a deliverable physical settlement settled contract, by, they can, just a day before that,
Yeah,
they can close
reverse.
out their position.
Correct.
So
They can
see,
close out.
my point is, it is basically breaching the fundamental principle of law of one price. The point is that they need to remain organically connected. Now, what has
Yeah, but
happened in the case? Look at the USA, Chicago Mercantile Exchange. You look at Chicago Board of Trade. All these leading, European and American, derivative exchanges, physically settled contract delivery is hardly anything. It's not zero, but it is absolutely 0.0, 0.4, 0.2. In fact, one of my speeches I said, in a physically settled contract, delivery of delivery doesn't happen except in a very small, at a very small level, precisely because it can happen. That's very important.
yeah.
So there's a huge difference in the pricing. I mean, the price discovery, they need to be aligned together. That can happen only when it is physically settled contract, not if it is cash settled contract.
And like, just one more clarification on your point. Like, I fully sympathize with you that if you don't organically connect them, it's like literally like a casino gamble on the commodity. I agree with you. But and you're also absolutely correct that you can turn around your position on the second last day or something and avoid the cash settlement. But it's important to understand was that it is actually, even cash settled contracts are linked to the underlying, because the price of the contract on the last day will be equal to the underlying, right? Otherwise, there will be arbitrage. Right? People can arbitrage. So in other words, just because it's cash settled doesn't mean it's totally delinked. Because on the last day, the price has to converge. So the last day it's fixed to be at the underlying value.
I have an
And
answer to that.
Yes, yes.
I respond to that by saying that, let us say that it is a cash settled contract. Now, the last day, the price is fixed. And arbitrage, I'm talking about arbitrage. Arbitrage has taken because he found there's a disconnect. The futures is more expensive compared to the cash price today. So he does the typical theoretical, what the professors and academics teach every day in the various colleges and universities.
Right.
You understand? Then what they say is, so he takes a long position in the underlying, finances at the going repo rate, and then the implied repo rate is higher. That's why the futures is expensive. So he sells futures and he wants to make an arbitrage profit. Now let us see what happens in the last day. Last day, the settlement price is fixed by the exchange, right? That price is supposed to be the same as the cash price. If that happens, there is no risk. But now what happens? The guy who has taken a physical, he has bought the security or a stock physically. Now he settles this on the last day. Then he still is stuck up with that long position. I mean, he's holding that stock, that asset. That asset, then he goes to the market because he didn't buy the asset just to, put it somewhere and do a puja of it. He bought it for the arbitrage, risk-free arbitrage, riskless arbitrage.
Absolutely.
Now when he goes to the market looking around, hey guy, I have got this thing, will you buy? How much will you buy? The settlement price was say 120. Now he goes there and he finds he can actually sell it for 110.
Yeah.
So he is making a loss of 10 rupees. Or it is possible that it may be 130. So it is not a riskless, risk-free arbitrage. That is the hallmark of the law of one price, arbitrage-free cash derivative.
What you're saying is
arbitrage.
Just because the exchange sets the price doesn't mean you can actually get the price, because there are
Exactly,
issues
that's a
involved
very
in
important
actually
point.
buying and
That
selling.
cannot happen. That cannot happen because of physically settled contract.
That's fine.
That's my point. That's my point.
So your points are very valid now. So that's fine. And it's true that many commodity futures and CME also are not cash settled. They require delivery. I'm agreeing with everything you're saying, but also I'm trying to say that both things coexist in the world. No? So like people see positives and negatives. I would argue that the fundamental trade-offs are between liquidity and gambling type stuff. So if you don't link the thing to the underlying, there is a chance that the market will be completely delinked from fundamentals. It's just become a casino gambling situation. And I think there's a real danger of that. On the other hand, requiring physical delivery, even if you can reverse out your position, does create a sense of a notion that it's linked to something fundamental. And any trader might feel that I have to deal with the underlying at some point, maybe with some small chance. And so it creates an undercurrent that it's a friction in the market. the cash settlement, right? See, I'm not trying to take a position one way or the other because I'm not actually in that job, as you know. I'm supposed to teach these things and do research. But you're on the ground and understand the realities best. So I would say that if that's your judgment, that's fine. I accept that, respect that. But I'm just saying that as someone as an academic, I see both sides, right? So like if you require cash settlement, the problem is many traders will say, boss, underlying से मुझे नहीं मतलब, मैं नहीं deal करने वाला, मैं जा रहा हूँ, मैं कहीं और जा रहा हूँ. तो वो चले जाएंगे कहीं और अपना स्टॉक फ्यूचर्स करेंगे या कुछ करेंगे, लेकिन उनको अगर लाना है आपको मार्केट में लिक्विडिटी बढ़ानी है, तो you have to consider what's convenient for them. The flip side is कि आप उनको casino gamblers बना देंगे, लेकिन थोड़ा
I'm very happy the Tyagi SEBI. For the first time in 25 years, the Tyagi SEBI has introduced the physical settlement of the single stock. Futures, you know,
तो
it
वो
has
तो
been introduced, and I complimented him. That
is actually quite good.
Another point is, no. See, one thing is there, we have to do the right thing. That is the whole point. Otherwise, we should not teach in the class that this is arbitrage free.
आप जो कह रहे हैं वो ठीक. अरे सर, आप मेरी बात तो सुनिए. What you're saying is correct, but यार sorry boss, apologize. What the right thing is complicated, no? Like आप लिक्विडिटी बढ़ा रहे हैं कि आप उसको निक कर रहे हैं. लिक्विडिटी की भी तो बात होती है ना, कितने लोग उसको ट्रेड करेंगे. आप ये समझिए कि कोई अगर एक्सचेंज इंट्रोड्यूस करता है तो उसमें उसका भी फायदा होना चाहिए, तभी इंट्रोड्यूस करेंगे. तो उनका फायदा अगर आप नहीं कराएंगे तो वो कहेंगे भाई हम ये कॉन्ट्रैक्ट फेल कर सकते हैं ना. The contract could fail. ये आपको बात समझ. मैं कोई I'm not taking any position. I'm saying कि all types of things to be considered. That's all. Obviously,
there are a few questions which have come up. I do not know if the chairman of the session wants to take them now.
I don't know. Let me know.
There's a question, we have this, there are two questions which are on the screen, and I have one more question on my cell phone. But the ones on the screen, I think Mr.
Actually, how do I actually see these questions?
Under the chat, but I'm asking them to read it to you. Mr. Vinay Gupta, he's a former commercial banker. Can you ask your question yourself?
Yeah, thank you. So my name is Vinay Gupta. My question relates to your presentation. What you had mentioned was that 94% of the out of the money OTM options result into losses. Now, what is the data on in the money options? I mean, do we conclude that about 95% of the in the money options result in profits or no?
No. So here's the story that. See, the aggregate number is a loss. Right?
Yeah.
So the point I'm trying to make here is that 94% of the profits are attributed to OTM options, right? So in other words, the total number, forget the sign of the number, the total number, 95% of the number can be explained by just OTM options. Since the overall number is negative, it means that 95% of the losses are incurred due to OTM options, but that's it. So if you're saying what happened in the ITM options, I don't know. But remember that if 95% of the losses are attributed to the OTM options, at most the ITM options could have yielded, some small profit of maybe 1, 2, 3%, whatever it is. But we haven't checked that, boss. So we can check that. But remember, the economic impact is a loss, right? And 95% of that loss is OTM options. So nobody's making any money in this, right? On aggregate, they could have made a little bit of money in ITM, but the bulk of the money was losses, and 95% of those losses were in OTM options.
So does it mean, let's follow up question, does it mean that 94% of the profits are taken by option writers and not the option buyers?
There is a little bit of that problem is there because this is not the full market, right? It's like one brokerage company. So clearly, every option has a winner and a loser. So somebody is making money from them, but it's not the retail investors. So obviously big brokerage houses, institutions are the ones that are making money. So who exactly made money, we don't know, but the institutions on aggregate in this sample make money. But the number of retails is much higher than the number of institutions. So on aggregate, it's a loss for the retails. That's all. So somebody made money, it probably is the large institutions, but we can't pin down exactly who. That's the thing.
Okay, thank you.
There's another question by Professor Jenna. Professor Jenna, do you want to ask yourself?
Yes, sir. Hey, good evening, Professor Subramaniam.
Yes,
so, I want to know whether that this standalone straddle are only concept, or we can use that in the call option, put option. Because when I was reading like advanced call and put option, so this concept was there. So can they are using in the like in the derivative markets, straddle and strangle? So I think it is more beneficial.
No. Okay, so the straddles and strangles are useful if you understand what they're useful for and the conditions under which they may be useful, right? So I very much doubt if the retail investors in the Chinese market understood a straddle and a strangle, but clearly many of us in this audience actually do. But the thing to remember is that obviously nothing in the real world is a guaranteed profit unless in extreme circumstances like this market where you sold a worthless option to someone else. That would make you a lot of money. See, the thing with straddles is that I think that I would say it's unlikely that they're actually applying these sophisticated strategies, at least the retail investors. But even if you apply a straddle, it's a tricky one because obviously with the straddle, what you're doing is you're buying a call and a put. And you're saying you're trading volatility, right? So if the stock moves a lot in the extreme direction, you make money. And strangle is somewhat similar, except that you have a band of the exercise price. There's a divergence in the exercise price. That's okay. But here's the thing that we want to make sure we understand that we are not overpaying for the volatility. So the cost of a straddle is how much you pay for the call and option, call and put to actually set up the straddle. And you have to make sure you use some sort of model to price the call and the put such that you find that the call and the put price are undervalued. Right? If they're not undervalued, then the straddle will, on average at least, not make you money, right? Because if the initial money you put up to set up the straddle is too high, then the profit from the straddle will not be sufficient. So my point here is that without understanding the Black-Scholes and formulas like that, you should not set up straddles because otherwise you might be overpaying for the straddle. So these things are tricky, right? It's not obvious that you actually make money on these things because the cost of the straddle comes up front, right? And so you have to consider that. And what I'm saying is the cautionary note that these things can be done well if we understand the fundamentals driving the option price to begin with. And they're not costless. You have to pay for the option to begin with. Those are my comments. On summary, I don't think the Chinese investors, the retail ones at least, understood a straddle or a strangle. They just viewed it as another market to buy a lottery ticket, basically, in my opinion. So, okay. That's my answer.
Yes, sir, another complementary question. In India, is it working? I want to know in India, is that people are using when they're investing in advanced call options?
In India, what's the question? Are people investing in the call options? Is that the question? Plus,
in India, by using straddle, are they making money or they are not using? That I want to know.
No. So definitely in the NSE situation, the option chains, they are using straddles. That much I know because I've talked to some of these people. They are using straddles. But, I can only tell you as an academic what I know in terms of the evidence. That the NSE should do a study on what's going on. I think it's very important that they do that study. But as of now, I don't think there's any evidence they're making money, or for that matter, losing money. But yeah, I don't think there's any evidence. They do these things, but whether they actually make money is a different story. The option market.
I can ask the chairman, sir, since he's a practical person. He can comment, sir, what is happening in India.
No, boss, the question is whether they're making money in option markets or not. That's the question. On aggregate, are they making money? Or who's making money, let's say. Yeah, sorry.
Yeah.
Thank you, sir.
Achha, so this question was for the Charan. This question was for the chairman. I don't know. Sorry. I was just restating.
No, it's okay. And what I'm saying is that making money or not making money depends, na?
I know.
You're making money some of the time, you're losing money some of the time.
That's right.
This is how it is. But yes, Professor Avani sir.
Yes, sir.
Hello. One question I could ask you that is very important in the context I was discussing. This lack of physical settlement at true arbitrage creates a lot of basis risk for the true hedgers. Because basis risk is created by speculators and manipulators. Because because of the leverage, they can really do whatever they want. And that creates a very substantive, this basis risk for hedgers. There is end in its, what is the end and what is the means. derivatives are supposed to be means the end is subserving the real sector. The real sector is the economy. The hedger should get the benefit. Either denied the benefit
Sir,
basis risk because of that.
your point is valid, but it could be also argued that, look, boss, you're on the ground. You know best. I understand that. But as an academic, I'm supposed to give you both sides. So my point of view again is that, like, it's not obvious to me, with due respect. आपकी बात सही हो सकती है, लेकिन the notion that hedgers actually are incurring basis risk as a result of cash settlement is not clear to me. Because if you require the physical delivery, the hedger's commodity might be some wheat quality that's not deliverable. So, मतलब अगर wheat hedging कर रहे हैं आप या oil कुछ भी कर रहे हैं, the point is that the deliverable has to be equivalent to what you're actually hedging against. But you might be hedging something completely different from the deliverable. The deliverable might require a certain quality or certain types of specifications that you may not satisfy. So from your perspective, when the hedging is cash settlement is better, no? Because you may not have access to the deliverable in terms of its specific features. Because like कभी exchange अगर deliverable specify करता है, तो उसको terms भी specify करने पड़ेंगे ना, कि ये commodity इस time पे इस quality पे आप deliver करिए. लेकिन hedger के पास वो quantity शायद हो या ना हो, right? उसके पास कोई दूसरी क्वालिटी हो सकती है. तो प्रॉब्लम ये है कि अगर आप ये रेगुलेशन डिलीवरेबल का करते हैं, तो यू शुड इंश्योर दैट द डिलीवरेबल has sufficient range such that the hedgers can actually deliver the deliverable. Otherwise, cash settlement is better for the hedger too, right? I understand you can close out your position before expiration, but then nonetheless, if it's a credible threat that you have to deliver, then the range of the deliverable has to be sufficiently large, because not every hedger has access to the deliverable. So, ये बात भी important. That's all.
Okay, thank you. Okay.
There are two more questions which have come on my cell phone, but they are in the audience. If the chairman permits, can I, with your permission, can I request Krishnanand Tripathi to ask, because he has sent me on the cell?
Okay. He can, yes.
Yes, Mr. Subramaniam, am I audible to you, sir?
Yes, sir.
Yes.
Sir, I wanted to ask something which is outside this debate. I am a practicing journalist based in New Delhi. I wanted to take this opportunity to ask you about the India's economic growth. In the first quarter, it was it contracted by 24%. RBI's own estimate for the entire year is almost 10% contraction. How do you think the second, third quarter onwards, will it improve with the festive season and going forward? Or if the situation deteriorates in the winter, so whether our economy will further decline, how do you see this thing, sir? What is your take, sir?
Okay, boss Charan, we are going outside of the realm of the
I agree. As a chairman, I agree. I think this is outside this thing. Yeah. Let's confine to the derivative.
सब लोग अपना अगर part करें, देखो, I'm a novice in this, right? I'm not doing a macro position here, but like basically everything is to do with the infection rate. That's the main thing. So I mean, as far as I can see, the only reason that a vigorous and dynamic economy like India is suppressed is because the infection rate. Like आप सब मास्क पहनिए और केयर जाइए, मूवी थिएटर ना जाइए, मॉल में ना जाइए, 6 महीने रुक जाइए, तो सब ठीक हो जाएगा. लेकिन अगर you insist on having your same lifestyle and taking risks, as the young generation, you feel you can take the risk. But it's not exactly like that. Even if you get the virus, you may recover. But as the infection rate rises, the government will not be compelled to actually remove the restrictions. So the main reason here is the high infection rate. It has the highest infection rate in the world at this moment. जब तक वो कम नहीं होता है, तब तक कुछ नहीं हो सकता. So, policymakers won't be willing to take chances. You know, they're being very sensible, much more sensible than some other countries, including US. But that's very important, right? Kam karna. That's the main thing. But anyway, that's not my policy, arena. I mean, I'm just saying intuitively what makes sense to me. That's
I see the point. Yes.
So there is another question which has come, and I think it pertains to both. It's a very rare combination that we have a professor of finance from UCLA Anderson, one of the best schools in the world, and we have the chairman who's been the derivative guru of our own country and has been at the helm of affairs in policy making for nearly a decade and is still active. So here is a question which I'm going to read out to you. The question is, and you both can answer, the question is, the derivatives market in India has been always very simple and been very carefully regulated. Is this the right strategy given the situation that Professor has just mentioned about China?
आप बोलिए आप सर आप you go first. चलिए.
I mean, I don't know. I mean, the whether derivatives markets in India is simple.
Yeah,
Can you clarify? I don't know. I mean, but I don't quite get the question.
the question is that relatively, of course, the derivatives market in our country has been very seriously regulated and is relatively a simple market.
Simple market.
Simple. अरे यार.
So probably in the nascent stage.
I don't know. I mean, it's very difficult to respond to that. Can he come on the line? I mean, can he speak like the other person spoke?
Correct.
The point they're making is that this in India the market has been highly regulated, and is that the right strategy given that the investors are not very educated, and that is the right strategy which the central bank has followed? I think that's the point they're making.
That's interesting.
I would say that in fact after what this SEBI has done in terms of introducing physical settlement, I very strongly feel the result. Interest which is not, and anything that is cash is physical. That is the all developed mature markets around the globe. USA, UK, Europe, Japan, they're all physically settled.
Yeah, I argue that the goal of regulators should be to make sure the market is economically useful as opposed to just deadweight cost on gambling. So agar regulators ठीक से regulate नहीं करते हैं, the market goes wild and it just becomes gambling then what is the point of having another gambling den in the country? What is the point of it, right? The economic usefulness is very important. So if the economic usefulness requires some sort of regulation to make sure the market's connected to fundamentals, then I'm all for it, I think. I also think the exchanges should monitor that to make sure that people who don't understand them don't trade too much of them and lose too much money on them, because after all, the large banks make money simply by going against the retails. And so if you don't monitor to make sure that people are educated and they have good understanding of what they're doing, these things can be both deceptively simple. I'm telling you, like you say, acha, this is great, yeah, I can make some money from it. But when you actually trade these things, they can be pretty complex. So I think some level of regulation and education is important. And also it's important to connect on the fundamentals. See about this, these things are relevant, yes. I don't want to go too deep into this, but yeah, those things are obviously very relevant.
You're mute over. Charan?
Hello, Charan.
Yeah.
Finished? Anything else?
I don't know if there are others who want to ask questions. Are there any observations which both of you want to make as the speaker and the chairman? I read this paper a lot, and my own feeling is that what Professor has just concluded is very relevant. They look simple, but they can burn the fingers. And as he has shown from the data in China, I think it's very relevant for us that the literacy, financial literacy of the masses has to increase. Otherwise, if losses multiply, at the end of the day, whom are they going to complain? To the regulator. So I think the professor's conclusion and the choice of the paper to be presented to the audience in our country, I think is very relevant. Also, Professor, I did not mention it to you, but in the audience we had people from the regulator, we had policymakers, we had academicians, we had students, we had a very good mix of people in the audience, and I think your paper is going to be very well read, and I think your conclusion is very well received. I think the policy implication of what you have brought to our notice is that financial literacy in these things is very important, and in nascent markets where people are beginning to enjoy the openness and new instruments, they are vulnerable to these sort of risks, and therefore the regulator has a prominent role to play in those. I think this is the conclusion which I am understanding, but I leave it to both of you if you want to conclude by making any more observations. Professor and the chairman of the session, please.
I just want to not make a big. I just want to say that it was a thank you, Charan, for giving me this opportunity. It was an honor also to be with the derivatives guru. So I just want to thank him for coming as well. That's all. Nothing else. You summarized it very well. So I'm good.
Thank you. Thank you. Thank you. Thank you very much. So I have nothing to say. I have said whatever I wanted to say. And I think this was a good insight into the market in China. This warrant, they are over the counter there, or it is a...
No, exchange trade. No.
Warrants are exchange traded there.
Exchange traded. Yes.
Is it?
Yes, it is. Right now even. Exchange trade.
Exchange traded.
Shanghai. You can trade them in Shanghai, SSE. Shanghai Stock Exchange. Yeah.
Hello.
नहीं यहाँ पे CBOE Chicago Board Option Exchange. It's traded dealer market.
Warrants are traded there.
Okay. Options are traded there. Yeah.
Option
warrant yeah, I agree. The warrants are traded on NYM and the New York Stock Exchange, American Stock Exchange, mostly American Stock Exchange. But they're not OTC. They're on exchanges.
They are on the exchange warrants.
But they're not as liquid as they could be. But they are on exchanges.
Okay. Because supposed to be OTC more. Yeah. Okay. Thank you so much. Thank you all of you, and thanks Charan for inviting me to this very interesting program. Look forward to more such opportunities. Thanks a lot.
Thanks everyone. Acha Charan, thank you.
I want to conclude by thanking the professor as well as Mr. V.K. Sharma to spare his time on a Friday evening and be with us. As you know, EGROW does a weekly webinar series which are very educative and on policy making, whatever is relevant for policy making. Next Friday evening, we have Professor Anjani Kochar from Stanford University. And Friday after that, on October 30th, we have Professor Kose from Columbia University. Professor Anjani Kochar will be speaking on rural livelihood. He is going to present her results, which she has done a survey in India. And Professor Kose is going to be speaking on the housing markets. So for the next 2 Fridays, I would request you to spare some time. Same time, both of these speakers are from, one is from Stanford, West Coast. The other is speaking from Columbia, and therefore the timing will be the same, 6 to 7 p.m. next Friday and on October 30th. With this, let me thank once again the professor and all of you. I apologize for the inconvenience in starting. It's my mistake. I should have kept the professor informed that we are doing it on WebEx. I almost took it for granted, and I think that's my error. And in future, we'll make sure we start on time. Once again, thanks everybody.
Thanks.
Good night. Take care.
Thank you. Bye.
Thank you. Thanks everyone.